of The Money Manager. In the studio with me in Cape Town is Ebrahim, who is the CEO of Oasis. We're going to be talking about the Oasis Crescent Global Equity Fund. Global equities are in focus all the time, of course, but with an interest rate cycle that could be potentially turning, is this the sort of event that changes your attitude towards a fund like this one, or you still stick to your guns and you're completely focused on stock picking?
Completely focused on stock picking.
Well done.
And as that interest rates rise, our day arrives.
Yes.
And so if you think about it, we're value managers.
Yes.
And when interest rates are low and when you have quantitative easing, what you're doing is supporting the poorer quality companies, you're supporting momentum investments, and those momentum investments are those where there's good long-term growth, but very little near-term profit.
Right.
So if you have a very low discount rate, you're actually raising the value of the long term relative to the short term.
Yes.
And as interest rates rise, the equation changes around, the discount rate rises, and the value of the long term decreases, and the value of the near term increases quite dramatically. And so our time has arrived. And so
you almost look as though you're looking forward to the next few weeks before the decision, and then possibly the next couple of years.
We've had a tough 8 years from a headwind point of view, although we've done fantastically.
Yes.
But this is like been running up and down escalator, and now we just run with in the same direction as the escalator.
Yes.
And we look forward to that. And if the running up the down escalator lasted 8 years, hopefully this will last 8 years.
Could do.
And it's already started. While interest rates they're only planning to move interest rates up over the next month or three in the US and the UK, but spreads, both credit spreads and emerging market spreads, have actually moved up over the last 18 months by about 300 basis points. And we're only talking about a 0.25% increase in interest rates as the first go.
Yes. Is it fully discounted, do you think? I don't want to focus too much on macro, but it is a fascinating story, because at one stage I thought in my lifetime of broadcasting, I'm not going to see another interest rate rise. It's just going to stay low forever.
No, they'll come around. Just when you think that something's never going to happen, when the market's too high, the market's rising for 10 years or 8 years, and surprise, it comes down. And when it goes down, you never think it's going to go up again. And it does go up. So that's what makes fantastic markets. But over the very long term, the economy grows, the stock market grows, and you just got to be aware that there's cycles.
Yes.
And there's good cycles and bad cycles, good times and bad times, and position yourself for both of those.
It's very interesting what you said. QE has supported poor quality companies. So there's almost like a 2 or 3 and maybe even 4-speed stock market perhaps. Poorer quality companies getting dragged along with the momentum trade. Will there be a washout of these poor quality companies and the good quality companies will maintain their prowess?
So what's happened is the poor quality companies have got this turbocharged boost,
yes,
and they've remained in business. The interest rates have come down, the availability of capital. They haven't actually improved their competitiveness. Yes. They remain poor quality companies. Now, as you take interest rates away, as you take liquidity away, the real truth comes to the fore. And so what happens, we hope that some of these poor quality companies fall by the wayside.
Yes.
And so 10% of supply goes out. That needs to find a home. It goes into the stronger companies, stronger factories. They hire more people.
Yes.
They build more factories. So we've thought that quantitative easing has actually been destructive and actually led to lower inflation. And then we just have more quantitative easing because of low inflation.
So there's going to be a concentration of quality almost if and when interest rates start to rise, which is very good for a fund like yours.
Yes, exactly, and that's what we've positioned. And then, unfortunately, it's not so good for poor quality companies, and then it's not so good for those countries that have got some bad discipline over the last 5 to 7 years. And unfortunately, South Africa is one of those countries like Brazil and Russia. So our current accounts have washed out, and our budget deficits have washed out, and we've reversed some reform. Our labour practices are not as aggressive as they should be,
yes,
or not as practical as they should be. And so countries like South Africa will face a tough time going in that scenario.
Yeah, and it seems as though I was talking to somebody earlier today, and they said it's been 5 years now that we've been in a downturn. And it really does feel as though it's almost, you get so used to it, you become numbed to our lack of progress.
But you know what? When we're thinking that government's going to provide that progress, we've now suddenly, I have a meeting immediately after this with one of the large industrial companies. The management are coming to my office. And for the first time, we would have anticipated with the weaker rand, once it passed 10.11 to the dollar, that was a long time ago, that's a strong rand today, we'd have thought that the export side would have led the way. And it hasn't. But more recently, in the last 6 months, we're now starting to hear the talk that the manufactured exports are starting to gain. The high, good quality companies are able to take advantage of this weak rand and able to export. And then, the weak rand at 14.50, tourism, both domestic and global tourism, if we can sort out the visa situation, $20 for a high quality restaurant, high quality meal. I mean, $20 for a foreigner, they'd normally pay $100, $150.
This is a gold mine, this town. I mean, these beautiful places you can see behind us here. And I know we bumped into each other last night at the V&A. The place is absolutely teeming, and foreigners are here. So we've got a gold mine, even though we keep on putting barriers in the way.
Yes, so what we need to do is take those barriers away. We need to speak up our confidence. And so we're actually quite enthusiastic about South Africa, and we have been. But not all parts of South Africa. Let's bank those parts that are not great, and we don't focus on them. And we focus on those companies and sectors that are competitive, like we do globally. So globally, we have a very low exposure to those poor quality companies and those poor quality emerging markets.
Right.
Like Brazil, amongst others. And so we've put a lot of money behind some of the biggest and best companies in the world. We've bought them cheaply. We're getting 5% dividend yields on many of them. And by the way, they've got the strongest cash flows. They've got the strongest business models. They're the guys that actually prosper in these times. And then the portfolio, what we've done, Lindsay, our ROE in the portfolio is about 25%.
Yes.
Compared to MSCI's ROE of 10. So 2.5 times. Our debt levels are a quarter of MSCI's debt levels. Our free cash flow is approximately 50% higher. So we kind of really got the, we've bolted down the hatches, and we're ready to, for this environment. And by the way, our companies are healthy and robust and ready to perform.
These sort of statistics that you're quoting now must have drawn attention to your funds from people that maybe hadn't looked at it before.
Yes, we've been having a busy period. And so we've had a number of global wealth managers add our funds to their platforms over the last six months. And hopefully over the next month we have one of the biggest adding our funds. I wouldn't want to, you only talk about these things once it's signed, so I won't mention the name.
But the pitch is well advanced, is it?
Yes, it's right in the end zone now, and so people will start looking for funds like ours, for fund managers like ourselves, and then all those kind of momentum investors. There's very few value investors left in the world because it's been a very tough environment for value investors.
And also the term value is used very loosely, I find, by fund managers. People say, yes, I'm a value manager, but you look at their portfolio construction, their sectors, etc. You say, well, that doesn't look that value orientated to me.
Exactly. And so it's, one must be careful just using a brand, and you need to, some of the statistics that I spoke to you about, they're value statistics, PE ratios, very low PE ratios, free cash flows, price to book ratios. But importantly, we're buying the best companies incredibly cheaply. So companies that are 2.5 times more profitable than the average, and we're buying them ridiculously cheaply.
Yeah. Let's have a look now at, let's do two analyses now. The geographical analysis. Not surprising to see the United States at the top with 62%, and quite rightly so.
So, I think the US companies are doing well. So we overweight US, UK, Europe. We have no China exposure, or very little China exposure, mainly indirectly.
Yes.
And we kind of have a very low emerging market exposure. So the US companies, the US economy is performing really well. The UK economy is performing really well. The companies are in a healthy position. They're investing very substantially. Their factories are modern. Most of the R&D, most of the innovations coming out of those countries. And by the way, in a place like the UK now, the corporate tax rate is heading down to 18%.
Yes.
So you also have a very favorable environment for companies to prosper.
It's very interesting you talk about the tax, because I think you can talk about Allergan and Pfizer getting together because of synergies and cost cutting, etc. It seems to me the main reason that they're doing it is because the whole company, once the deal goes ahead, is going to be domiciled in Dublin, and the tax rate there is 12.5%, and Pfizer at the moment paying 35% in the States.
Yes, in fact, if you, on a look-through basis, US tax rates, if you add municipal and local taxes, is 39%.
Yes.
Now, one of the attractions why we like the US companies, and we like Pfizer, and Pfizer's a big holding in our portfolio.
Oh, well done.
Why we like, and we've held it for many, many years, it's a market leader in pharmacy, and it's a really great company. But there's no reason why one country should be paying 39% and another country should be paying 14 or 13 or 12.5.
Yeah.
And what you will have over time is a kind of normalization. So we've taken the view that US domestic companies, so if you look at a US domestic company versus a US exporter like Google, the average Google rate may be less than 20, but Pfizer and Verizon at 39 or 35, 39%.
Yeah.
So over time, the 35, 39% will come down,
Yes.
either through inversion, or alternatively, I think this whole move by people like Pfizer will force the US to cut their corporate tax rates.
They have to, and I think people like Hillary Clinton are having a look at this deal, and they're up in arms about it.
Yes.
There's nothing they can do.
Yes, until they lower tax rates. So what companies will do, they will find the best fiscal environment, and that's a danger for South Africa if we don't have a favorable fiscal environment. So what we think the US will do over the next 5 years, maybe 10 years, they will lower their rates. Now what that means, if you had $100
Yes.
and you were paying 39% taxes, you were left with 51. Now, if the taxes normalize to the European Union taxes, say just to 25,
Yes.
from 39 to 25, so your profits left for shareholders will go from 51 to 75. So just that tax change will boost US company profitability so dramatically. And they will continue to invest, they will continue to employ, and that's why we're so excited about the US.
I've led you astray, Adam, with other talk, but it's a fascinating chat. You'll come back, of course, after your pitch has been successful, and talk more about the fund next year. Thanks so much for your time this evening. That's Adam Ebrahim, who's the CEO of Oasis. We've been talking about the Oasis Crescent Global Equity Fund. That's it for The Money Manager.